Hello everyone, welcome back to the principles of macroeconomics. Now we come to the last chapter, chapter 20, aggregate demand and aggregate supply. So in this chapter, you should be able to explain why the aggregate demand curve is downward sloping. Identify factors that cause the aggregate demand curve to shift. Derive the short run and long run effect on output and prices according to the aggregate demand and aggregate supply model. Given a scenario about an economic shock, determine the effect of an economic event on the position of the long-run aggregate supply curve. Contrast the slope of the long-run aggregate supply curve and the short-run aggregate supply curve. Determine the effect of a change in one of the determinants of aggregate supply given a graph of the short-run aggregate supply curve. Explain how the sticky wage theory, sticky price theory, and other theories affects equilibrium, and identify the long-run equilibrium in the aggregate demand and aggregate supply model. So overall, in this chapter, we try to put all the goods and services all together in one large model, right? So let's get to some basic concept. So in the first part, we will talk about what is economic fluctuations and how we can identify them. So the economic activity fluctuate from year to year. So sometimes it's a good year, like an economic boom uh, between the 2003 and 2006, and also the kind of economic recovery from the pandemic since 2021. And we also have some bad time in which the economic fluctuation goes to the trough. So for example, the dot-com bubble bust in 2000 and the 9/11 event in the 2001. So that caused a recession. And then we come to the great financial crisis in the 2007 to 2009. That also leads to a recession. And most recently, we experienced the uh, we experienced the pandemic, and during the pandemic, there's a disruption of the supply chain, so that also leads to a recession. So you can see that all the activity is just have ups and downs. So the recession is a period of declining real incomes and rising unemployment. So you can consider recession is a period of time that the entire economy shrink, so becomes smaller. The total production becomes smaller. People's income becomes smaller, and then a lot of people get laid off because of the size of the economic activity becomes smaller. Then the depression is a more severe type of recession. So the depression can be considered as a consecutive recession. So the recession lasts for a long period of time. So normally a recession only lasts for less than a year, but for the depression, it can span over several years. So let's look at what will happen uh, in the in the economic fluctuations during the ups and downs of the economy. So in this figure, we show the real GDP in panel A. So here is a real GDP, uh, and the next panel is unemployment, and the next one is for the U.S. economy. So all the recessions are shown as the shaded areas. So all those shaded areas are the period of recessions. So you can notice that real GDP and investment spending decline during recessions while unemployment rises. So you can see this kind of pattern uh, uh, incur time after time during each recessions. So you can see here a decline of a real GDP, decline of a real GDP, decline of a real GDP. However, recession doesn't mean the real GDP have to goes down. So there's another situation we can also consider it as a recession. So if the real GDP growth dramatically slow down, we can also identify it as a recession. So, for example, in the 2001, after the 9/11 terrorist attack, you can see the growth rate, the real GDP becomes stagnated. So it means that it doesn't it stopped the growth during and we call that period as a recession, right? So it is unnecessary to be a decline of the real GDP. So if the growth rate become dramatically slower, then we can also consider that as a recession. So that is one thing that I want you to notice. And then for the investment, it is more dramatically affected by the business cycle or by the economic fluctuation. So during the recession, the investment dramatically decline, right? So it is not very hard to understand. So investment is about the behavior of the firms in their business decision and also relevant for the household decision on purchasing new house. All right. So during the recession, people's income become lower and their perspective about the future become unclear. So because of those two reasons, people's sentiment or people's willingness to invest become lower, right? So during each recession, the investment actually goes down. And then for the unemployment, it is for unemployment we can call it is a pro-cyclical variable. So it means that it goes up during each recession. Uh, Yeah. So in each recession, the unemployment goes up. It's simply because that when the economy size shrink, then the production also decline. So the firms cannot afford that amount of labor demand. So a lot of people get laid off because of a decline in the labor demand. So here you can find that during the economic fluctuations, a lot of variables actually move together. So some of them move in the same direction of the fluctuation. So when the economy become better, those variables increase. So we call them as a pro-cyclical variables. So you can see that the real GDP and the investments are pro-cyclical variables. All right. We can also see some of the variable move in the opposite direction to the business cycle or the economic fluctuation, like unemployment. So when the economy become better, this variable goes down. So the unemployment rate is a typical counter cyclical variable, right? After we so we can see that the economic fluctuation uh, is a phenomenon that we can witness in the historical data. And then the most critical question for us is that how can we understand this economic fluctuation? And more importantly, is there any way that we can prevent it happen, or is there any way that we can prepare for all those economic fluctuation, right? So in order to prevent or prepare for those fluctuation, we need to get a better understanding of them. So this is a key part for the second component of this chapter. So we consider a model of aggregate demand and aggregate supply model to explain what actually happened in the macroeconomy. So this model can also short for ADAS model, right? So uh, uh, sometimes when you read the economic news or read the textbook, you can see the ADAS model. So you may wonder, what is that? That is exactly the aggregate demand and aggregate supply, right? So it is a model of short-run economic fluctuations, focuses on behavior of two variables, right? So we divide all the variables into two parts, all right? So one is a real variable, which is an output of goods and services. It is a real GDP, as we learned before. The real GDP is a change of the quantity of production that already exclude the variation of the price. All right, so it is not the market value anymore. It just measures the real quantity that is produced within a given period. So we call it as a real variable. And another part of the model is a nominal variable. It evaluates the average level of prices, like a CPI or the GDP deflator. So it is only about the change in the prices, right? So in this model, we try to use those two pieces of information to evaluate the what actually happened in the economy, and use that to explain the economic fluctuation. So why do we use those two kind of variables? So here we actually consider all the good we consider all the goods and services as uh, as a whole market. So in this market, we have the seller or the supplier of all those goods and services. We also have the demand side or the buyer of all those goods and services. So we put all of them together. And then the key question is, what will be the quantity and the prices of this system, right? So it is quite easy to know what is the price or quantity of one particular good. But when we look at this macroeconomy, it is quite hard to see what is the price of the entire economy and what is the quantity of the entire economy, right? And then we refer back to the definition of everything that we learned in the chapter of the GDP and the chapter of the price. We know that the CPI is a variable that measures the overall price level of the economy. So you can consider that the CPI or the GDP deflator or a price index as a as an evaluation of the overall price level, right? And then for the GDP, for the real GDP, it is the real production. It is exactly the quantity that will be produced in a given country. So it is consistent with the concept of the quantity. So that is why we use the real GDP as a quantity in this market, and use the CPI or the GDP deflator as a price of this aggregate supply and aggregate demand model, right? So this is the rationale behind it. So in this model, in model that most economists use to explain short-run fluctuations in economic activity around its long-run trend. All right. So in this model, we can actually summarize the information both in the short run and the long run. Right. So for the aggregate demand curve and aggregate so in this huge market of all the goods and services, we have a demand side. We call that aggregate demand curve. So it is a curve that shows the quantity of goods and services that household, firms, the government, and customer aboard want to buy at each price level. So it talk about the buyer or the end user of all those goods and services. And then for this market, we also have a supply side. So who actually produce all those goods and services? So it is a curve that shows the quantity of goods and services that firms choose to produce and sell at each price level, right? Okay, so here we already have all the elements of this model. So the four key elements. So we do need to have a price. So that is a price level of the entire economy. We need a quantity. So that is the quantity of the output. And then we have a supply curve to summarize the supply side and a demand curve to summarize the demand side. And that's all. That's all the element in this simple model. Right? However, there's something else we need to also, so now after we get the structure of this model, then we need to add more details to it. So the economists use the model to analyze economic fluctuation. So on the vertical axis, so here is all the element. So this is the framework that we will work on in the entire chapter. Okay, so now we get to some details about the aggregate demand. So from the demand side, who actually demand all those goods and services? So we can think about the expenditure method for the accounting of the production. So I don't know whether you still remember that when we try to calculate the total amount of production, we find it is very difficult to collect the price and quantity information of each particular goods and sum it up. So it is quite impossible to do the accounting through the market value of all the goods and services. And then we propose to use the expenditure method. So we discussed that the total expenditure should equal to the total production, because all the production will be used or being spent by one particular end user, right? So the end use, all those end users are actually comprise or consist the demand side of all the goods and services, right? So the aggregate demand curve is actually a summation of the information of those four end user, right? So let's just do a review of what we learned. So the total demand or the total spending or total expenditure is equal to the consumption of the household plus the investment of the business or the firm's investment, as well as the household investment on the residential housing, and plus the government spending for the public good or public services, and plus the net export that is enjoyed by the foreigners. So there are three effects explain why aggregate demand curve slopes downward. So as we said, this model is a model that we try to discuss the relationship between the price and the quantity, between the price level and the total amount of production, with a total amount of quantity. So here, why the price is relevant for the total spending. All right. So here, why is not the production, because we haven't get to the supply side yet. So why at here is the total amount of goods and services that are demanded by the economy. Okay. Why is the total expenditure? Why is the total demand? Right. So this demand is influenced by the price level from the following three channels, right? From the three channels. So the price level will affect the consumption, will affect the investment, and will affect the net export. For the government spending, we just assume it is fixed by the policy. So the government will determine how much they will spend. And this is a decision that is irrelevant to the price level. So we just make that assumption, and then we can see, then we will talk about what actually happened when the price change. Right? So for the consumption, what is the wealth effect? The wealth effect means that when people have a higher nominal income or have a higher nominal value for their asset, they tend to spend more. All right. So let me give you one example. Um, so suppose you own a house, and this house do not give you income. Income is a periodical inflow for your wealth. So the appreciation of your house do not give you money, right? You cannot receive any money from the appreciation of the house, because if you it will only realize when you sell the house. All right, as long as you hold the house, you do not get you do not get any cash or get any income out of it. However, when the house appreciate, you become wealthier, right? And when you become wealthier, you tend to spend more, because you know when something bad happens, what you can do. You can put this house as a mortgage and to borrow the money. So you don't need to set aside of a certain amount of money for something bad happen in the future. All right. So you have more tendency to spend more, right? So that is a wealth effect. So when the asset value increase, it will increase your wealth, and this wealth will increase your tendency or the propensity to consume. So that is a wealth effect. So when the price level goes up, you can see that everything increase in the price, as so it is also valid for your asset, right? So it will lead to a wealth effect. So the consumption could goes up. And then for the investment, it have an interest rate effect. For the interest rate effect and the exchange rate effect, we actually talk more about it in the following slides, right? So let's talk, before we get into the detail of those effects, we would we need to briefly look at this entire structure. So what will happen when the price change? So a fall in the price level from P1 to P2 increase the quantity of goods and services demanded from Y1 to Y2. So in the later slide, we will talk about the mechanism of it, but here is the general impact of the price change to the total demand. There are three reasons for this negative relationship. All right. So when the price level falls, the real wealth rises, the interest rate fall, and the exchange rate depreciate. So why is the case? The real wealth means that the real wealth is a nominal wealth divided by the price level. So when the price level goes down, your real wealth it goes up. In other words, your purchasing power of those wealth become higher. And then when the price level fall, the interest rate will fall accordingly, because the lender will require a lower level of the interest rate if they just want to secure a real interest rate. So if the real interest rate doesn't change, when the price level goes down, the nominal interest rate will goes down. And lastly, the exchange rate will depreciate. So the local currency will become cheaper if the price level fall. All right. So this effect stimulates spending on consumption, investment, and net export. It will increase spending on any or all of these components of output. It means a larger quantity of goods and services demanded. Right? So first we look at the wealth effect. So as we talk about, as we briefly discussed, so a lower price level will raise the real value of money and make consumption wealthier and encouraging them to spend more, and increases in the quantity of goods and services demanded. So when the price level is lower, the the purchasing power of the money or the purchasing power of their asset become higher, and then they tend to spend more, right? And then for the investment, a lower price level will reduce the interest rate. As we said before, the lender require a will require a lower nominal interest rate because uh, because because they can still secure a real interest rate. So what the lender care about is a real interest rate. So they want to get a certain amount of real return on their lending. So when the inflation goes down, we know that the nominal interest rate is equal to um, the real interest rate plus inflation. So if the price level goes down, the inflation actually is negative. So in that case, the lender will require a lower interest rate. So it will encourage the spending on investment good because the interest rate is a cost of a capital for the demand side. So it will increases the quantity of goods and services demanded and the vice versa. So last part is related with the net export. So we actually skip the chapters related with the international economics, but here we just briefly talk about the intuition behind it, right? So the exchange rate effect is as follow. A lower US price level will cause the US interest rates to fall. So the interest rate is the nominal return that you will get if you hold a local currency, right? So the real value of the dollar will decline in foreign exchange market because your nominal return become lower. It will lead to a depreciation, and then that will stimulate the US net export. So when the local currency becomes cheaper, then it means that if you use a foreign currency, you can purchase all the good produced in your country with a cheaper price. For example, so if the exchange rate, if the so consider two countries, China and the U.S. So if currently the exchange rate is 1 to 1, right? So it means that if a hamburger is $5 in the U.S., then it is like a 5 yuan in China. So they are equal with each other. But now, when the U.S. when the U.S. dollar depreciate, so it means that the U.S. dollar become cheaper. So now, if the exchange rate is become 2 to 1, so it means that $2 you need to use $2 in exchange for $1 in Chinese yuan. So in that case, what will happen? You still spend $5 in the you still spend $5 uh, in the United States to purchase or maybe produce a hamburger. But when you sell it to China, the Chinese only need to like spend 2.5 yuan to purchase your hamburger. So the real cost of purchase of the hamburger in China become lower. So it means that the exported good become more competitive in the foreign market. So a depreciation of the local currency will make the production of the domestic market to be more competitive in the foreign market, and vice versa, right? So this exchange rate effect means that if the price if the price level of the domestic economy is low, it will lead to a depreciation of the local currency and an increase of the net export. So you will find that the aggregate demand will increase when the price level goes down. Okay, so it constitutes the the aggregate demand curve. So for the entire aggregate demand curve, it may shift when anything happens to those four components. So let's look at one practice question to see how the changes in those components will affect the aggregate demand. So a 10-year-old investment tax credit expires. So that will lead to a decline in the investment because the demand side of the investment have less incentive to do so. So in this case, the investment will go down. So that will lead to a decline of the aggregate demand. So the entire aggregate demand curve will shift to the left. B, the US exchange rate falls. So when the US exchange rate falls, it means that the US dollar becomes cheaper. Then the product produced in the United States become more competitive in the global market. And in that case, the net export will increase. And then the aggregate demand curve will increase as a result. C, a fall in prices increases the real value of consumers' wealth. So when the price goes down, the real value become higher for the consumer wealth. So when consumer have a larger amount of wealth, then they tend to spend more. So the consumption increase, the aggregate demand will be positively affected. D, state governments replace their sales taxes with new taxes on interest, dividend, and capital gains. Right? So here is a mixed effect. So first, the government stopped the sales tax. So if there's no sales tax, so the consumption will increase because all those consumer good will has a less tax. So the sales tax is a tax that you need to pay when you purchase all those goods and services, right? And then a new tax on the interest in dividends and the capital gains that will reduce the money supply or the capital supply in the market, and that may push up the interest rate. So for the investment, it will be affected. So here, the consumption, at least the consumption will increase, but whether it will affect the investment, we don't have enough information. All right. Okay. So after we talk about the demand side of the economy, then we talk about the supply side. So what will be the determinant for the production? So first, in the long run, we have a vertical aggregate supply curve. So what does that mean? It means that the aggregate supply is irrelevant to the price level. So when the price level change, it will not change the long-term aggregate supply. Why it is the case? Because in the long term, the aggregate supply is actually determined by the production capacity. So if you don't have enough machines or enough labor to produce, in the short run, you can accommodate that, but in the long run, it is very hard for you to change the entire production capacity because you need to make some long-term capital expenditure. You need to make some long-term plan um, in order to shift the long-run aggregate supply. So in the long run, an economy's production of goods and services, its real GDP, depends on its supplies of labor, capital, and natural resources, and on the available technology used to turn these factors of production into goods and services. So in the long run, the aggregate supply is determined by the productivity, and then the productivity is determined by those four factors, right? Human capital, physical capital, natural resources, and the technology. So all those factors are unaffected by the price level. So in that case, the long run aggregate supply is vertical. So it means that no matter what is the price level, the production just cannot exceed its capacity. So in the long run, the quantity of output supplied depends on the economy's quantities of labor, capital, and natural resources, and on technology. Since the quantity supplied does not depend on the overall price level, the long run aggregate supply curve is vertical at the natural level of output. So the natural level of output is the production of goods and services that an economy achieves in the long run when unemployment is at its normal rate. So this is the level of output when the entire economy is wrong, is run at the full capacity, right? So any change in the economy that alters the natural level of output shifts the long run aggregate supply curve. So for example, for any kind of technological revolution, for example, the use of the electricity, the invention of the internet, all those things will shift the long run aggregate supply. Um, However, all those changes do not happen in a very short period. So for example, will not happen in the 1 year or 2 year. So the invention of the internet may may affect the long run may affect the long run aggregate supply, maybe in a time span of like a 10 year or maybe 20 years. All right. So the output in the classical model depends on labor on those four factors based that will affect the productivity. And the one thing that I need you to bear in mind is that the productivity cannot change overnight, right? So it has nothing to do with the short run, and all those things has nothing to do with the price. So that is why the long run aggregate supply is vertical. All right. So um, after we after uh, we get the aggregate demand and the long run aggregate supply, then we can use those two curves to discuss the long run implication between the economic growth and inflation. So if there's a change in the economy's long run trend, the aggregate demand and long run aggregate supply curve, both of them will shift. So and on the other side, the short run fluctuations in output and the price level should be viewed as deviations from long run trend of output growth and inflation, right? So here are something that may affect the equilibrium, right? So first is a continuous shift of long-run aggregate supply to the right. That is a technological progress. So and this will be a very gradual process, and this process can last for a very long period of time. So at least in the unit of decade. So when we say the technological progress is not a kind of a small improvement in the way of production, it is talk about the dramatic change of the way of production. So, for example, a transition from the handmade into the mass manufacturer. So this kind of a change is what we mean by the technological progress. And the aggregate demand curve, the AD curve shift to the right. So for example, the monetary policy, so when the Federal Reserve lower the interest rate, the entire aggregate demand will increase. And when the Fed increase the money supply over time, it will lead to a continuing growth in output and continuing inflation, right? So when the Fed increase the money supply, the interest rate will goes down. When the interest rate goes down, it means that it is much easier, much cheaper to borrow the money. So the consumption will goes up, the investment will goes up. So both of them will lead to an increase of aggregate demand, and this may have some long-term impact, right? So in this graph, we can illustrate the impact of those of those two events that we talked about in the previous chapter, previous slide. So first is a technological advance. So it leads to an increase of the long run aggregate supply. All right. So it's a rightward shift of the vertical line. And then when the Federal Reserve increase the money supply and reduce the interest rate, you can see the entire aggregate demand will increase. So it's a kind of a parallel shift to the right. And then you can see the price level gradually goes up, gradually goes up. And the total amount of production is also goes up. So both of them are expansionary. So both of them will lead to expansion of the economy. So when we say the expansion, it means by the increase of the production per year, and it is also mean by the increase of the price level. And then after we talk about the aggregate supply in the long run, and then we shift our attention to the aggregate supply in the short run. So in the short run, the aggregate supply is actually affected by the price level. But how and in what mechanism? So this is a question that is haunted by for um, for economists for a long period of time. So what factor actually contribute to the interaction between the short run aggregate supply and the price level? So there are three type of theories that may explain why the aggregate supply curve slope down upward in the short run. So in other words, it explains why the aggregate supply increase when the price level goes up, right? So those three theories still have some controversy over them. So not a single one of them can explain everything, right? So here I just want to introduce those development in the literature, and then which one do you believe and which one you want to rely on is of your own choice. But what I would say is that you need to understand all of them, and then maybe all those theories will work together to explain this kind of upward sloping aggregate supply curve. Okay, so we start with the sticky wage theory. So the sticky wage theory is talk about the cost of production. So here the basic idea is that the nominal wage cannot change immediately because of a lot of reasons. So for example, the long-term contract between workers and firms. So if you sign a 5-year contract so if you are an employee, if you are a worker, you sign a 5-year contract with your firm. So during those 5 years, your wage will not dramatically change. So it is very hard for you to renegotiate the contract within that 5 years because it is a contract. It is something that bind your behavior. And the second factor is slowing changing social norms. So when people already accept a certain level of the wage, then they will sit on it. So they do not kind of actively negotiate or actively seek for a new wage, right? And lastly, is a notion of the fairness. It will also influence the wage setting. So sometimes some individual is very productive, so they are eligible to negotiate a higher wage. However, some of the institutions actually need to be fair to everyone. All right, so it means that for all the other people that they didn't have a chance to increase the salary for a long period of time, and then for you, you just need to tolerate this kind of a slow growth of the wage simply because other people also cannot have this kind of chance. All right, it may this fairness may be unfair to those individuals. However, it may be perceived as fair to the vast majority. All right, so for all those kind of reasons, you may find that the nominal wages do not really respond to the current economic condition. So maybe now there's a dramatic increase of the price level. Everything become more expensive. However, your nominal wage is still remain at the previous level, right? So this is what we call the sticky wage. So it means that the nominal wage do not really change to the current economic condition. And then in this situation, you will find that if the inflation is very high, the inflation goes up, what will happen? Your real wage will become lower, right? Because the real wage is the nominal wage adjusted for the price level. When the price level goes up, the real wage uh, will become lower. So for the firms, if the real wage paid to the worker become lower, it is more profitable for the firm to produce, right? So in this case, the aggregate supply will increase because of this decline of the labor cost of this labor um of the cost of labor. So this sticky wage theory is actually work from the cost side of the production, right? So the second theory is try to explain this kind of a positive relationship through the benefit side. All right. So what kind of thing that will induce the seller or the producer to produce revenue, right? So what will happen to the revenue when the price when the price level goes up? So if the price level increase in a magnitude that is smaller than your expectation, then the firms are incentive uh, uh, to produce less output. So if the firms expect the price level will goes up by 5%, but actually it only goes up by 1%, what does that mean? It means that the firms expect you have like a 5% of the profit margin simply come from the inflation. But now the profit margin actually shrink by 4%. So the firms can earn less from the production. In this case, their incentive to produce less, and vice versa. If the price dramatically increase, it means that everything become more expensive. But for the production, you still use the original cost to produce. So in this case, you have more bargaining power in when you sell your product. So this increase in the price level will give the firm more incentive to produce because of this kind of benefit from the price increase. So here I want to to ask you to pay attention to the different perspective of the producer and the consumer. So for the consumer, inflation is something bad, right? Because the inflation will erode their wealth, will make their purchasing power lower. However, for the firms, it is a good thing because if there's an inflation, the firms have a right to make to sell the good more expensive, more expensive, right? So the prices of some goods and services are slow to adjust changing economic conditions. And when the firm is trying to increase the price, it will incur the manual cost, which is a cost to changing the prices. So the firms cannot change the price immediately. So you can consider that the firm will set their price as an expected price level. So now if the price level actually become much higher, the firm cannot immediately change their price into that higher level. So now what will happen? They produce at a level that is lower than the optimal level, because now the optimal level is actually at a higher level because of that higher price. So in this case, what will happen? It will lead to a recessionary output gap. In other words, the production will be lower than the natural rate of production. That is a recessionary gap. And then when the if the if the if the price level is lower than expected, the firm is actually will incentive to produce less output, right? So this sticky price theory is work from the benefit side of the production, so or the revenue side of the production. And lastly is the misperceptions theory. So the misperception theory means that the firms may be hard to distinguish between the change of the overall price level and the change of their individual the change in the price of their individual good. And then they may be confuse those two signals and then make a decision that will lead to this positive aggregate supply curve. So changes in the overall price level can temporarily mislead suppliers about changes in individual market and changes in relative prices. The suppliers respond to changes in level of prices and change in quantity supplied of goods and services, right? So when the suppliers consider the change in the level of prices as the change of the relative price of their production, what will happen? They will consider there's an increase in demand for their own product. Then, because of this increase in demand, in the short run, the producer will meet this demand by work overtime. So in this case, you will see an increase in the production. All right. So this is misperceptions theory. Okay. So let's review those three channels. All right. So for the sticky wage theory, it is about the real cost of hiring. Right. So when the inflation is high, the real labor cost will decrease. Then it provides incentive for the firm to produce more. The sticky price theory is about it work from the revenue side. So if the price level dramatically increase, then the firm will incentivize to produce. Price level is very high, it will incentivize to produce more output because the price level is very high, but they cannot adjust their price. So the only thing they can do is to adjust to the change in the demand. When the overall price level become higher, then for those firms that cannot change price, their product become cheaper, and then it means a higher demand for their goods. So it gives them a incentive to produce more, right? So if they cannot change the price, they need to meet the demand from the um, from the from the production. And then lastly is a kind of misperception. All right, misperception of the supplier may lead to increase of aggregate supply when in the case of the increase in the price. Right. So all those three channels may work together to explain the short run aggregate supply curve. So in the short run, a fall in the price level from P1 to P2 will reduce the quantity of output supplied from Y1 to Y2. So this positive relationship could be due to all those three reasons. So over time, wages, prices, and perceptions adjust. So this positive relationship is only temporary. So eventually, those contract, those sticky wage will be adjusted. The final price will be adjusted, and all those perception will be revealed by what happened in the economy. So in the long term, all those